one of the questions for a lot of the clients here is, which framework do I sign up to? And so Maxime has mentioned the Net Zero Asset Owner Alliance. Helena mentioned the Transition Pathway Initiative, which is their methodology is linked to the Paris Aligned Investment Initiative. Then you also have the SBTI when it comes to their approaches for net zero target. And all want to head to the similar direction of reaching net zero. But when you just go under the bonnet and look at what some of these methodology means, there can be substantial differences. So I think Maxime mentioned with the Net Zero Asset Owner Initiative, there's interim targets, so 2025, 2030, and they ask for a carbon footprint or a carbon intensity based target. And so again, that is, I think, what we could describe as your the emissions of your the current emissions of a company, and then you're trying to reduce it by 25% by 2025 for your whole portfolio, and then 50% by 2030. And I think it's interesting talking to clients about this because some have already made that commitment. They make it relative to a 2019 benchmark, and quite a few are already nearly there. And I think that's partly related to, I think a lot of firms have gone for the coal exclusion side, and that kind of takes out a big chunk of your initial portfolio emissions. And then they've done a few more things to their portfolio to get them closer to that 25 intensity reduction or carbon footprint reduction. I think what we do tell clients and to really think about is that bit is the first step. What happens in 2025 to 2030 and 2030 and 2040 can be more challenging as the low-hanging fruits go away. It will be dependent on what the policy path and the emissions reduction path of the economy as a whole. And depending on how that would work, it could lead to, if they stick to that target, potential sector allocation. So I think Maxime mentioned, like we looked at the same sort of data, 80% of our portfolio emissions are in 5 sectors: energy, transportation, utilities. If you really wanted to, you can just swap it out to retail and tech, but that's not necessarily what you want to do. And so you can actually think about this, and also if you look at carbon intensity from a regional perspective as well. So if you look at emerging market companies, particularly in Asia, it tends to be higher carbon intensity. It's a more reliance on the fossil fuel mix. You could switch out to emerging markets to developed markets, but that may not really meet any of your portfolio objectives. And so I think that's kind of a clear communication to think about what that means from a tracking error, or just really what it means for your risk return profile should you stick to that target.